guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, we will talk about how Elon Musk has sent out a powerful warning that could shape your financial future. The current market climate has stirred significant concern, and together, we'll explore the wide-ranging implications. Let's unravel the accuracy of Elon Musk's tweet and consider whether other influential factors are at play. To refresh your memory, Musk warned that future rate hikes, including the one on May 3rd, would unleash a severe recession. That was his bold statement. Now let's analyze the current situation. In the bond market, the probability of a rate hike in June has dropped to zero. Some even speculate about the possibility of a rate cut, although it remains a mere 1 in 100 chance. The one certain rate hike is no longer guaranteed. Additionally, the recent release of the Consumer Price Index or CPI has armed the Federal Reserve with crucial economic data. Get ready for an exhilarating ride as we navigate this intriguing landscape and uncover the truth behind Elon Musk's tweet. Let's analyze Elon Musk's statement and the concerning outlook for the upcoming fall season. There is a significant possibility, almost 80%, of a rate cut, which contradicts the Federal Reserve's unanimous stance of no rate cuts until 2024. This shift in the market's outlook is remarkable, as even respected brokers, analysts, and economists were not predicting a rate cut until late Q1 of 2024. Are financial news outlets misleading us? Could they be manipulating the narrative? Well, the truth lies in the bond market. Examining the bond market, the disparity becomes apparent. The Fed projects the bond market to reach around 500 to 525 basis points by year-end, yet they claim no action until 2024. However, the market is already factoring it in as zero. This discrepancy is concerning. Furthermore, when we analyze the probabilities, the chances of rate cuts become significant. The likelihood of rates being between 475 and 500 basis points is only 1.8%. And the chance of rates being between 500 and 525 basis points is zero. This suggests a strong possibility of rate cuts with almost an 80% chance of at least 3 cuts. Let's talk about the reasons behind the significant shift. It is not due to inflation being under control or economic problems being resolved. Inflation has remained relatively stagnant. There are underlying factors at play here, and understanding them is crucial. If we closely examine the metrics from April to May, we see similarities across various categories. Some are improving while others are not. But why the sudden flip in the bond market? This change in market sentiment could have a substantial impact, particularly on Treasury bonds. If this trend continues, it would be beneficial for TMF. With Elon Musk's perspective, why would the Fed suddenly change course and implement 3 to 4 rate cuts by December? The answer is simple. We would face a severe stock market crash and a recession much worse than just a mild one. It's important to acknowledge that calling it a mild recession undermines the significant impact it has on millions of Americans who lost their jobs and face life-altering disruptions. Such a recession requires government assistance as job opportunities dwindle and individuals and families endure financial hardships. Some speculate that the authorities intentionally want to slow down the economy due to a worker shortage, hence causing the recession. They believe the Federal Reserve deliberately raised rates despite warnings from Congress and public pleas not to do so. If individuals are interested in following StockMo's investment moves, they can join his Patreon community where he shares his strategies and insights. He also offers a private Discord group exclusively for members. StockMo welcomes thoughts and comments in the designated section as the focus remains on making profitable investments together. StockMo acknowledges that if his predictions turned out to be incorrect, he is committed to admitting it and facing the consequences in his portfolio. However, he remains steadfast in his beliefs, which are reflected in his investment decisions. Placing trust in Elon Musk's assessment of a recession, StockMo anticipates its severity to escalate due to the recent rate hike. Additionally, he holds optimistic expectations for specific stocks in his portfolio to perform well amidst the recession. Furthermore, StockMo has high hopes for treasuries as they navigate through the anticipated rate cuts. The key is to exercise patience and wait for the first rate cut, as it has the potential to trigger a chain reaction resembling an avalanche. Let's explore some investment options in the current market conditions. Remember that longer duration treasuries are more sensitive to interest rate changes. Here are a few options to consider. Number 1. TLT. The TLT is an exchange-traded fund or ETF that tracks the performance of long-term U.S. Treasury bonds with maturities of 20 years or more. It is designed to provide investors with exposure to price movements of these bonds without using leverage. As a low-risk investment option, TLT offers stability and is often used as a safe haven during times of market volatility or economic uncertainty. Number 2. TMF. TMF is an ETF that seeks to provide investors with leveraged exposure to the performance of U.S. Treasury bonds with maturities ranging from 7 to 10 years. This ETF is designed to amplify the daily returns of its underlying index by a specified multiple, usually 3 times. While TMF offers the potential for higher returns, it also carries increased risk due to its leveraged nature. As a result, it is important for investors to closely monitor their positions and understand the potential for amplified losses as well. Number 3. T-bill. T-bill ETFs offer a simple and low-risk option for investors who want to invest in U.S. Treasury bills. Treasury bills are short-term debt obligations issued by the U.S. government with maturities of 3 months or less. These ETFs invest in a portfolio of Treasury bills, providing investors with exposure to the performance of these securities. T-bill ETFs are considered safe investments as they are backed by the U.S. government and have low default risk. Number 4. Inverse ETFs. Inverse ETFs are designed to provide investors with returns that are opposite in direction to a specific market index or benchmark. For example, an inverse ETF tied to a stock market index aims to deliver positive returns when the underlying index declines. SDO is one example of an inverse ETF that seeks to provide 3 times the inverse daily performance of the Dow Jones Industrial Average. These types of ETFs can be used by investors who want to profit from market declines, or as a hedging tool to offset potential losses in their portfolio during market downturns. Regarding tech stocks and interest rate cuts, it is generally believed that tech stocks can benefit from rate cuts as they tend to negatively impact by rate hikes. Lower interest rates can make borrowing cheaper for companies, stimulating economic growth and potentially benefiting tech companies. However, if interest rates decrease significantly, it may be an indicator of a severe recession or economic downturn, which can have a negative impact on the overall stock market, including tech stocks. Remember to conduct thorough research, consider your risk tolerance and investment goals before making any decisions. Share your thoughts and engage with fellow investors in the comment section below. Together, let's focus on making smart and profitable investment decisions that propel us towards financial success. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.